Watch for that. And I myself am from Argentina, and they're playing tonight as well. So, guys, let's get started. Today we have an amazing, amazing session. I'm just going to share my screen. If you guys can let me know if you can see it correctly, that would be great. Can you guys see my screen okay? Yes, perfect. Yes, I'm getting a lot of yeses. Great. Okay, guys. Well, today, as I said, we're going to have an amazing, amazing session. We're going to learn strategies to unlock financial freedom and build generational wealth with smart investing. And we are so lucky to learn it from someone whose mission, it's his mission, is to spread financial education, Jaspreet Singh. So Jaspreet, to tell you guys a little bit about him, and it's just a little because there's a lot, he is a successful and serial entrepreneur, investor, and he's the sensation behind, I'm sure you guys know it, My Mindset. It's the viral YouTube channel with around 2 million subscribers and a podcast with more than 100 million views. He is also the founder and CEO of Briefs Media, a daily newsletter that provides the financial news, trends, and education to be a smarter investor and build more wealth. One of our favorite quotes by Jaspreet is the one, if you can put your money to work well, you can buy your time back and you can buy your freedom back. Jaspreet has been on Mindvalley stage multiple times, and he has a quest on Mindvalley actually called Smart Money, which we will be speaking about more in detail later today. Jaspreet's success is due to his simple, non-nonsense advice, making real and generational wealth an option for anyone who wants to learn. He's already transformed the futures of thousands of ever grateful students, and now he's ready to do the same for all of us. So please help me give a warm welcome in the chat to Jaspreet Singh. Hi, Jaspreet. So happy to have you here with us. I'm really excited for today's lesson.
Well, thank you for the beautiful introduction. I always really
You're welcome.
appreciate that. Thank you for having me on. And just as a supporter of Mindvalley, you guys are doing such amazing things here at Mindvalley. Hello, everybody. If you can hear me and see me okay, could you let me know in the chats because I can't see you, but you can see me. And the only way that I know that if you can hear me, all right, I'm getting some hellos in the chat, is if you engage with me. Okay, perfect. So I'm going to share my screen and we're going to jump right in because, well, your time is valuable and I want to make this as valuable as possible. Could you give me access to share my screen, please? As I get access to share my screen, one of the things that I like to do when I do webinars like this, it's a little different and a little strange, but work with me. I think it'll be fun. Is because I don't know if something that I'm saying is providing value or not. The best way for me to hear that from you is if you engage with me. And the way that I like for you to engage with me is to chat in the comments or give me some guac. And what I mean by that is you have an avocado emoji in your computer or your phone. And if you can take the avocado emoji and paste that in the chat, that is an easy way for me to know if you're getting value out of what I'm saying. That way I know that what I'm saying is making sense. So if that makes sense, could you give me some guac? Perfect. Fab, Shireen, Duffy, Kim, Marcus, Aria, thank you for the guac. Perfect. Oh, you guys are doing an amazing job. This is how I know. This is what I do in my workshops. A little strange, but it helps me understand if you are getting value out of what I'm saying. Now, let me just share my screen properly. Give me 1 second. All right. And now let us jump right in. So I always like to start with a little disclaimer. I'm not a financial advisor. Everything that I discussed today is for educational purposes only, and it should not serve as financial advice. I am not a licensed financial advisor. If you have specific questions, talk to a licensed advisor in your area. And investing has risks. You are never guaranteed to make money when you invest. In fact, you will probably lose money at some point. So make sure you always do your own due diligence and never trust a random guy on YouTube or never blindly trust a random guy on YouTube. Now, the way that you can get the most value out of today's discussion is number one, close out your other tabs. There's going to be 60 to 90 minutes of just pure value. So if you can close out your other tabs, put your phone on silent, get a piece of paper and pen handy because we're going to go through things very quickly and just block off the next 60 to 90 minutes. It is going to help you get the most value out of this discussion because I'm going to be moving through things very quickly And of course, interact with me because that helps me understand if you're getting value because I can't see your faces. So it always helps me to see the guac because I have your chat open on the side over here. So it helps me understanding that you're getting some value out of what I'm saying. Now, I know there was a introduction done on me already, which was amazing. Thank you again for that. A brief intro on who I am. I call myself a random guy on YouTube, and I'm the host of the Minority Mindset Show on YouTube. I am the CEO and founder of a company called Briefs Media, and I am now the teacher of the Smart Money Quest here at Mindvalley. Now, you might be wondering, why do I call myself a random guy on YouTube? Well, because I really am a random guy on YouTube. I started making YouTube videos on accident. I never grew up with any sort of financial education. It was something that I kind of had to learn on my own. My parents are traditional immigrants from a small state in India called Punjab. And growing up, I never really learned about money or investing or entrepreneurship. These were things that were actually discouraged. So I had to go out of my way to learn these things in secret because if my dad knew that I was doing some of the things that I was doing, he would be very angry. So I always kind of did what I did in secret. And so when I started making these videos, I always said I'm just a random guy on YouTube and was very fortunate to see my channel grow to where it is today. From there, I then started building Briefs Media, which is my media company where we focus on financial news, financial trends, and financial education. Like was mentioned before, we have a free newsletter called Market Briefs that breaks down what's happening in the financial markets into a fun reading, easy to read newsletter. And what's interesting about this whole journey is when I was getting started on my financial education journey, I would spend a lot of time reading financial news sites like Yahoo Finance. And now what's interesting is Yahoo Finance goes to interview me pretty regularly about what's happening in the financial markets and how people can build wealth, use their money better. So it's kind of funny how things kind of came full circle in that sense. The agenda that I have for today is number one, I'm going to start by going over how money has changed over time. If you attended Mindvalley University last year, you might have heard me talk about this briefly. I'm gonna cover that slightly today. Then I'm gonna go over how to build wealth. Then I'm gonna go over how you can be a smart investor, and then I'm gonna put it all together. And then we're gonna wrap up with the question and answer section. So make sure you stay until the end because the question and answer section is, sometimes where a lot of the golden nuggets can be found because that's where, if you have specific questions, well, you can answer them here or I get them answered here. So let's start with part one, how money has changed through time. And I always like to go back a few decades. So if we look back at 1971 and take a look at how money was in 1971, it was a little bit different because the median household income back in 1971, this is in the United States, by the way, it was $10,290 a year, the median household income. If you wanted to buy a new car, the average new car cost you around $5,000. You wanted to buy a new home, the median home was selling for around $25,200. Can you believe that? And college, 1 year of college at a public university would cost you around $400. Well, we all know that that's not what it is today. So if we fast forward to last year, 2023, things changed. In 2023, the median household income was $70,784. That is an increase of 688%. But new cars, the average car in 2023 sold for $42,000. That's an 840% increase. The median home in 2023 sold for $484,000. That's a 1,900% increase. And college tuition is a lot more expensive. It costs $9,300 on average for 1 year of a public university, which is a 2,300% increase, which means household income grew by almost 700%, which sounds good, but it didn't really keep up with the prices of things that you and I all need. But here's the kicker. Household income also changed. Because if you remember, well, you probably don't remember, but back in 1971, household income was based off of one person's income. In 2023, household income was based off of two people's incomes. Back in 1971, the standard was that one person went to work, the man went to work and the woman didn't. That's how it was in the early 1970s. Well, in 2023, the median household is a two-person income household, which means now not only has household income gone from a one-person income to a two-person income, but despite the fact that household incomes now rely on two people's incomes, it still has not kept up with the growth of car prices, home prices, and college prices, which makes you want to wonder, what's going to happen in the future? What is 2050 going to look like? And this is where it is important to start building that financial education and start investing in your financial education, because the reality is this trend is not slowing down. This has been happening for decades, and it's even now more important than ever. And you're going to say, well, what do you mean more important now than ever? Well, let me just show you some data. If we look at just the last 5 years now, between 2019 and 2024, household income in the last 5 years grew by around 20%. Different sources will give you different numbers. Some are between 18 to 23%, but around 20% we've seen household income grow. At the same time, the reported inflation numbers were 22.5%, although the real inflation that many people felt was even higher than that. Home prices grew by more than 50%, but at the same time, the stock market grew by over 80% in those last 5 years. What does that mean? It means the financially educated, the investors, saw their wealth grow significantly faster than the people who are not financially educated, than the people that are not investors. If you were an investor over the last 5 years, you saw your wealth skyrocket versus somebody who wasn't an investor, didn't get to see any of those gains. And part of this has to do with inflation, but this is where now the the divide between the financially educated and those who are not financially educated has been going like this, and it's only accelerating, and it's not going to stop. It has been happening for decades, and it's going to continue to happen. And if you want to build wealth, you have to pay attention to this and start building your financial education. This is actually a chart that we published on Market Briefs. And what this shows you is that between 1985 and now, that we have seen household incomes grow by less than 65% adjusted for inflation. At the same time, we have seen the stock market, the S&P 500, grow by around 1,000%. See, this isn't something that just started during the pandemic. This has been happening for decades, and it's going to continue to happen, which shows why it is so important to build that financial education, to become an investor, to be smart with your money. That way, you can be one of the people that benefits from the way that the system works, because the reality is this is happening and it's going to continue to happen. And you can either hate it or you can understand it. That way, you can build wealth for yourself and your family. Which now brings us to part two. How do you build wealth? I'm going to take a quick sip of water. If you're getting value out of this, let me get some guac, please. All right. Thank you for the guac, everybody. Shireen, Lindsay, Miriam, thank you for the guac. I appreciate it. So let's go over now. How do you actually build wealth? What does this look like from a first theoretical standpoint? And I like to break this up, talking about what the majority of people do versus what the minority of people do, which is kind of what the minority mindset is all about, my podcast and YouTube channel, because the minority mindset means thinking differently than the majority of people. That's nothing to do with the way you look or your ethnicity or your skin color. So what the majority of people do is they make money, whether it's from their job or their business, and then you spend money, right? Well, not exactly, because there's an intermediary, if you remember. First, you got to pay taxes. You can't avoid the taxes. So you make money, you spend money, and then you wonder where all of your money went. This is what the financial plan looks like for the majority of people: is you're making money, you're paying taxes, and then you have no idea where all your money has gone to. But what the wealthy do, they do something a little bit different. You make money, you pay taxes, and then you spend some money, but you also always invest some money and save some money before you spend all of your money. But this is where things get interesting, because now when you invest your money too, right? They're talking about building wealth, and I'll show you how to do this. But when you invest your money, that means you get to make more money. because the whole goal of investing your money is to make money. Now, of course, investing has risks. You're not always guaranteed to make money, but the goal is to invest your money to earn some more money. But this is where it's interesting because now as you make more money, it can also give you more money to spend. And notice how this new arrow bypasses the taxes. Because what many countries, including the United States, do is they give you tax breaks for being an investor. That's lower tax rates, higher potential tax write-offs. So that means you can make more money as an investor and also pay less money in taxes so you have less money to spend. This is why this financial education is so important. So what do you actually go out to purchase? What do you actually do? What are these investments that you should buy to build wealth? Well, if we take a look at the three asset classes that have built more wealth over the last century than anything else, they are starting a business, buying real estate, or buying stocks. And you can use stocks or business kind of interchangeably. But these three assets have built more wealth than anything else. Now, there are other Mindvalley quests that go over starting a business. I'm going to be focusing more on investing more passively. And by passively, I mean in things that you don't have to necessarily operate. Building a business is a lot of work. It's a full-time job. You can invest in real estate and stocks while you're running a business. And so this is what I'm going to be focusing on for today. Which brings me now to the real meat that we want to go over today, which is how to be a smart investor. I'm going to take another quick sip and then we're going to jump into this because this is where things really start to beef up a little bit. How do you be a smart investor? And one of the things I like to talk about is what you should not do. So one of the things you should not do if you want to be a smart investor is go to Google and search, what is the next NVIDIA? If you've been hearing about all the hype in the video, let me get some guac in the comments so I know if you understand what I'm talking about with this. Now, NVIDIA, I'm not saying they're a good company or bad company. That's not what I'm trying to do. But what a lot of people end up doing is when they make a stock market decision, they look for where all the hype is. And so they make an investment decision because they hear people on the news or Reddit or some social community talking about the stock. And so that's when they go in and buy. NVIDIA, by the way, is now the most valuable stock in the world. It is one of the fastest growing stocks. And so it's been gaining a lot of media publicity. It's a company. And this is where, again, what I want to focus on is how you can actually make a good investment, not based off of a whole bunch of emotion and a whole bunch of hype, because what that ends up doing is it helps people buy high and sell low. And that's not what you want to do. You want to buy low and sell high. But when you invest on emotion, it's very easy to buy when things are expensive and then you get scared and sell when things are low. Same thing with GameStop. You might have heard people talking about GameStop and other meme stocks rallying. And you'll hear people talking about how they dumped money into it, which if you believe that's a good investment, fine. But the issue that I have is when people just start throwing money into it without knowing what they're doing. That's where the problems arise because you'll see a lot of people lose money, which makes other people rich because they start investing their money without any sort of financial education. And if you want to build wealth, you have to be investing on financials rather than emotions. And in order to do that, there are three things that you really need to understand. Is number one, you have to be prepared. Number two is you want to understand the financial trends. And number three is you want to be financially educated. Now, being prepared is all about being smart with your money, meaning you have cash put aside to protect you against an emergency. And it means you have cash to be able to go out and invest in an investment. Like you could see a great investment opportunity tomorrow. But if you don't have any money to go out and make the investment, well, it doesn't do you any good. That's what being prepared is all about. It's all about how do you have cash to protect you and also to be able to purchase investments when you see a good investment opportunity. Number two, trends is all about understanding how the economy is changing. how we're seeing a shift in spending habits, how we're seeing a shift in business trends. For example, artificial intelligence, how that is changing how businesses work, how people are changing their spending habits from going into the store to shopping online. These are different types of trends, understanding where is the money going. And then number three is financial education of how do you actually now analyze and decide what is a good investment or not. And that's what I'm going to be focusing on here. But just know that if you really want to see success, you also have to build that preparedness, which is have money to be able to purchase investments, understanding where the money is moving with the trends, and then, of course, the financial education. So let's jump into the financial education side of things. But before we do, I do want to mention a little bit more on the prepared and trends. Just something came into my mind that I wanted to mention as well. That way I don't miss saying this. When it comes to being prepared, the first thing I want to make sure is clear is when somebody is investing their money, like if you want to invest in stocks or you want to invest in real estate, the historic return, and I'm going to talk about this in a little bit, is about 10% a year, kind of the average return. Doesn't mean it's guaranteed 10% a year, but on average, if you factor in the booms and busts, it has averaged around 10% a year. If you have things like credit card debt or high interest debts, payday loans, or other things like that, those might be 15 to 25 or even 35% a year in interest. In which case, it might be better off, or it would be better off, for you to take the cash that you want to invest and use it to pay down those high interest debts faster. Because if you can pay down your credit card debt 1 year early, that's a guaranteed 25% return on your money. When you invest your money in stocks, you're trying to get a 10% return. But if you can pay down your credit card debt a year early, that's the guaranteed 25% return. So something to think about when it comes to being prepared. When it comes to trends, the thing that I always like to talk about is you want to go to where the money is moving. There's a famous hockey player called Wayne Gretzky, and he has a quote that says, I skate to where the puck is going, not to where it has been. Because in hockey, if you pass the puck, it's going to go in this direction. And if you just start skating here where the puck is, you're going to miss it because the puck keeps moving. That's what understanding the trends are all about. It's paying attention to what's happening in the economy. That way you can find opportunity. And it's very easy to understand this if you think about it from a real estate perspective. Because when people invest in real estate, that means you're going out and buying a property, whether it's a home or an apartment complex, and you're buying it not to live in, you're buying it to rent out to other people. Well, do you want to invest your money into an area where people are moving out of, where the crime is rising, where businesses want to move away from just because the property is cheap? Or would you rather move your money and buy a property where people are moving into, where businesses are moving into, and where crime is falling? And obviously, it's a pretty simple answer. You want to put it into the area where the money and the people and the crime is falling. You want to do it where the money is going. But that's the kind of mindset you want to have with all of your investments. It's where is the money moving? Now, in real estate, understanding these trends are relatively more straightforward because you can go to Google and search the population of a neighborhood and you can see where populations are rising, where populations are falling. You can go drive around and see where businesses are moving into and where they're moving out of. So it's a little bit, I guess, simpler to an extent to see those trends with real estate. With stocks, it takes a little bit more work because you're going to want to have to pay attention to what are the shifting trends that you're seeing. And a great way to start this is just to look around you, just to see what are people doing. For example, people are now starting to be a little bit more health conscious. That is also a trend. And so these are things that can help start your investment research of where do I want to invest my money? You just start looking at the different trends to see which industries are people putting their money into, which industries are starting to get more focus, which industries are starting to get more attention. And that's when you use the financial education to help analyze your investments to see what's a good investment or not so good investment. All right, so let's dive into that. If you're getting some value out of this, let me get some guac as well. All right, jumping into this. Thank you for the guac, everybody. The first question that I like to ask is it going to be an active or passive investment for me? I'll explain what that means. The second question I'd like to ask is this investment going to give me cash flow or growth? And then the third question I'd like to ask is, should I go through stocks or should I go through real estate? So let's break this down one by one, starting with active versus passive. Now, I want to make sure this is clear. When I say active versus passive, I'm not talking about trading stocks. Trading stocks is trading. It is what I call gambling. I'm not a trader. Active versus passive are two different ways to invest in companies for the long term. So let me explain what that means. And let me start by talking about passive investing because this is a little bit simpler to understand. And then I'm going to talk about active investing. Passive investing is a set it and forget it system. This is where now you're going to set up a system where every time you get paid, money is going to automatically be pulled out of your account and it's going to be invested into whatever investments you want. And you don't really have to worry about it. You just set it and forget it. And every week or every 2 weeks or every month, whatever you set, money is just automatically invested and it does not change. Doesn't matter if the market's up. It doesn't matter if the market's down. It doesn't matter if the market's sideways. It doesn't matter if it's raining. It doesn't matter if it's snowing. It doesn't matter what's happening. You're just going to keep investing. That's how you win in a passive investing system, but you have to do this for the long term. And by long term, I don't mean 6 months or even 6 years. This is multi-decades to really see the huge growth as a passive investor. So that's what it means to be set it and forget it. The things that you're going to be investing here as a passive investor are generally not individual companies. Generally, these are going to be funds. And by fund, I mean a group of companies. And there's a few different types of funds out there. ETFs, also known as exchange traded funds, mutual funds, and index funds. All three of these work very similarly, just with some slight nuances. For example, with an ETF, these are funds that trade on the stock market like any other stock. You can buy in and out of them multiple times a day. Index funds and mutual funds, you can only buy them once a day. So there's just some slight nuances. But what you want to understand with all three of these is that it's a way for you to purchase a basket of companies, a group of companies, as instead of buying one. I'll show you why that's important in just a second. But in the stock market, what that means is now instead of buying one company, you're going to buy this group of companies. And then every week, every 2 weeks, every month, you just keep buying more of this basket. And you just keep doing that no matter what. That's how you passively invest in the stock market. In the real estate market, the way that you passively invest is you're going to be investing into somebody else's deals. That means either you can find an investor who says, I am going to go out and buy this apartment complex and I'm going to redevelop it and we're going to rent it out and we're going to do X, Y, and Z. And you have the ability now to just give them money and you are a passive investor. So you still own a piece of it, but you're not doing any of the work. There's a lot of ways to do this. You can go out to real estate investor conferences that happen all around the world and look for investors that are trying to raise money and invest in them. Or you can go on the internet and look for crowd-funded real estate deals and just invest money there. And now you're investing your money into this fund of real estate. So let me give an example of this. One fund in the stock market, one of the more popular ones, is called the S&P 500. The S&P 500 is a group of the 500 largest companies in the stock market in the United States. So now, if I wanted to go out and invest in these 500 companies, I can go out and invest in each one of those 500 companies, or I can just invest in a fund that's giving me exposure to the S&P 500. There's a lot of funds out there that do that. You just go to Google and search some. But if I purchase one of those funds, now I'm essentially buying a little bit of those 500 companies. In the last 30 years, the S&P 500 has grown by around 1,100%. Meaning if you just invested into the fund as opposed to finding an individual company, you would have seen around an 1,100% growth over the last 300 years. The S&P 500 grew from 460 points to around 5,300 points today. Now, what is the alternative? Well, instead of investing in a fund like that, you could invest it in the Amazon stock. In the last 30 years, the Amazon stock has grown from 9 cents a share to $185 a share. That's more than 200,000% increase. Now you're going to say, well, Jaspreet, based off of what you're showing me, why would I want to invest in the S&P 500? Why would I want to invest in a fund? Because that's such a low return compared to what I would have got if I found the next Amazon. Well, you got to remember, if you invest in one company, you're taking on more risk than if you invest in a fund, because there's also a chance that you thought something that you bought was the next Amazon, but it ends up being the next Bed Bath & Beyond. Because over the last 30 years, Bed Bath & Beyond has gone from a great company to a bankrupt company, which means if you would have invested your money into this company, you would have lost everything. So if you want to have that set it and forget it model, where you don't have to worry about analyzing companies, where you don't have to worry about keeping up with the earnings and reading the financial statements and doing all that work, well, there are ways for you to just invest in funds. Now, there are funds for anything that you can imagine. There are funds for the 500 largest companies in the stock market. There are funds for healthcare companies. There are funds for technology companies. There are funds for real estate companies. There are funds for international companies. There are funds for Chinese companies. There are funds for emerging market companies. There are funds for really anything. And you can just start by doing a quick Google search to search the different types of funds in whatever industry it is that you want. Now, you're going to say, well, what industry? Again, going back to the trends, there are funds for pretty much anything that you can imagine. And I do want to also caution this with, you might say, well, Jaspreet, Bed Bath & Beyond, I knew they were going to go bankrupt. It was pretty obvious. Well, it wasn't always obvious, because if we go back to 2014, all the headlines from all the news agencies kept saying that Bed Bath & Beyond is an amazing company. It says why Bed Bath & Beyond is leading the way in home goods retail, and how Bed Bath & Beyond is purchasing out their competitors. See, when you're reading articles like this, you wouldn't think that in 10 years this company is going to be bankrupt. And this is where, if you're investing in individual companies, that's fine, but it comes with more risk, which means you can lose more money, but you can also make more money if you can find the right company and you're willing to put in that work. So when you're investing in a passive way, when you're investing in funds like this, you're generally looking for more average returns. And you might say, well, Jaspreet, what is an average return? What does that look like? Well, you can't predict what's going to happen next year or the future. All we can do is look at history. And in the past century, the stock market in the United States has averaged 10% a year. Now, that doesn't mean that it goes up by 10% every year. It means that on average, because don't forget, in the past, we've seen market crashes, we have seen recessions, we have seen booms, and we're going to continue to see recessions. We're going to continue to see booms. We're going to continue to see market crashes. They're going to continue happening in the future, and they have happened in the past. But in the past, we've seen about an average of 10% a year in returns. So what does that look like in practicality? If you invest $100 a month, which is $1,200 a year, and you do this for 46 years, from the day you turn 21 until the day you turn 66, and you only do $100 a month, and you never change that. That means from today you do $100 a month, and even 40 years from now, you still only do $100 a month, even if you're making a lot more money in 40 years. You stick with $100 a month, you get the average return, you will retire with $1 million. So yes, you can become wealthy even with the average returns. And many of you, I know, have the ability to invest more than $100 a month right now. And many of you will have the ability to invest more than $100 a month in 5 years or 10 years, because as you work to make more money, you'll have more money to invest as well, because you have the financial education of knowing how to be prepared, of how to use your money strategically. Which might make you wonder, well, okay, now I'm starting to understand what passive investing is. Well, what is active investing? Well, this is where now, instead of investing in a fund, you're investing in an individual company like Amazon, or hopefully not Bed Bath & Beyond. That's what active investing is. This is not trading. This is buying a company and holding it for the long term. And so now you're looking to buy this stock or real estate, this individual piece of real estate or stock yourself, and your goal is to buy it at a good price and hold it for the long term. Of course, it comes with higher risk, but it also comes with higher potential return. So if we look at Amazon over the last 20 years, $1,000 investment in Amazon is now worth $75,000 today over the last 20 years, but $1,000 investment in the S&P 500 is worth just $5,000 today. Investing in a company for 20 years is riskier because you can see that investment go bankrupt and you can lose everything. But in a fund, it's less risky because an interesting point that I'd like to make is Bed Bath & Beyond was actually a part of the S&P 500. And so then when they went bankrupt, the fund kicked Bed Bath & Beyond out and replaced it with another company. So this is where, you can invest in a fund and see failures, but they get balanced out by some of the winners. And so, yes, you see lower returns, but you also lower your risk with that as well. The question now that you might want to ask as you try to decide would it be better for you to be an active investor or a passive investor are, number one, how involved do you want to be as an investor? Do you want to spend the time researching companies, reading financial statements, understanding the cash flow statement, understanding the income statement, understanding the balance sheet? Do you want to spend the time listening to and reading the 10K and K1? Do you want to spend the time to really understand the companies? Or would you rather just have a set it and forget it system? Number two is how much time do you want to spend analyzing your investments? Do you want it to be set it and forget it? Or do you want to spend hours a week researching investments, real estate, stocks? Do you want to spend the time to actually go out and to research and understand the investments? How interested are you in studying the financials? Like I was just talking about, companies on the stock market are required to publish a quarterly report and an annual report. Do you want to go out and look at real estate properties yourself? Do you want to walk through the properties and look through deals and make offers and deal with contractors and property managers? Are you risk adverse? Are you comfortable with knowing that your company could go bankrupt, your investment could go down, and you could lose everything for the higher potential gain? Or would you rather have less risk? And can you manage the psychology of your investments? Like, markets go up and down. And when that happens, are you able to cut through the noise and keep reading the financials, or are you going to panic? And these are questions you'll want to ask to help decide if you'd rather be a passive investor or more of an active investor. Which brings us to question number two. What is your goal with your investments? Would you rather see cash flow, or would you rather see growth with your investments? And I do want to say on the active versus passive side, you don't have to necessarily pick one either. I do both. I have a passive investing strategy. I also have an active investing strategy. For my passive investing strategy, every Wednesday, money leaves my checkings account and is automatically invested into my portfolio of funds. On my active investing side, this is a little bit different. I have money that goes into a bank account that sits there and it's waiting for me to see a good investment opportunity, and then I'll go out and purchase those stocks. Now let's go on to cash flow or growth. Cash flow is where I'm going to buy an investment, whether it's real estate or stocks, and I'm buying it because this thing is going to pay me without me having to sell it. So when it comes to real estate, I can go out and buy a home or an apartment complex tomorrow, and I can rent it out. And if I do it correctly, the money that the tenant is paying me is going to pay for the property taxes, the insurance, the maintenance fees, the management fees, and any vacancy costs that we have, plus if there's any debt on the property, and then puts the money in my pocket. So I'm making a little bit of money every single month, but I'm getting paid without having to sell my property. That's what cash flow is. On the stock market, you also have dividends. When a company on the stock market, because you have to remember, when you invest in stocks, you're actually investing in a business. You're investing in a company. So if a company is making a lot of money, let's assume that a company has a lot of profit. That means they have a big bank account, a lot of cash in the bank. Well, there's three things that they can do with that cash in the bank. Number one is they can save that cash for an emergency. Number two is they can reinvest that cash back into the business. They can open more stores. They can hire more employees. They can build more softwares and technologies and do a lot of things. Or they can take that cash and just give it away to their shareholders, give it away to their investors, people like you and me. And that payment that they give you is called a dividend. And so not every company pays a dividend. Some companies do. And when you get this dividend, it's generally paid out every quarter, meaning every 3 months. And so it's cash that's deposited into your account every 3 months for doing nothing except owning that stock. That's what cash flow is. You get paid without having to sell. Growth is when you're investing for appreciation. So in real estate, it's me finding a hot area to invest my money, a very attractive neighborhood, buying this property. And maybe I don't make any money when I'm renting because the rent is barely covering all of my expenses. But I'm hoping that this property that I bought for $300,000 is going to be worth $600,000 in the future. In the stock market, you might be buying companies that are a little bit more young, a little bit smaller, a little bit more innovative, more startup-y, because you believe that this company is going to make a whole lot more money in the future and it's going to be worth a whole lot more money. You're trying to buy a stock for $100 a share to see it go up to $200 a share. That's what growth is. And you got to decide what's right for you. Personally, I like cash flow. That's the way that I invest. That's kind of the bulk of my investment portfolio is cash flow. So I like knowing how much money I can make every single month without having to sell my investments and without having to really work. Because now I can build systems where I can just buy more of these investments, whether it's real estate or stocks. My real estate can be managed by a management company. My stocks are passive in that I just have a set it and forget it system. And then every month for my real estate, I get money deposited into my bank account, and my stocks, every quarter, money gets deposited into my bank account. And so my goal then becomes how can I stack this cash flow? How can I grow how much cash flow I'm making this year, next year, the year after that, the year after that? But you got to decide what's right for you. This cash flow game is a much slower game because, well, if you start investing for cash flow, what you realize is year one, you're going to make next to nothing. Year two, you make next to nothing. Year three, you make next to nothing. Year four, you start to make a little bit more in year five. It's really a 10-year game plan before you start to really reap the rewards of you buying more of the cash flow and starting to see the rewards of that. So let's talk about the pros and cons. When you invest for cash flow, the pro is you get to lower some of your risk because you get that cash right now, right? You're getting paid without having to sell. When you're selling for growth, well, there's a chance that the thing that you invested goes bankrupt and you never get any dollars out. The pros are you also get paid without selling. And of course, you can live off of the cash flow. It's not easy, but if you can build a system to keep investing for the cash flow, eventually you have the potential to be able to live off of the cash flow. The downfalls of cash flow investing is, of course, this lower potential growth. Because if a company has all this cash in their bank account and they just keep giving it away, that means they're not investing back in the company as much as they could have. So there's less growth because they're not opening as many stores as fast as they could have. They're not hiring as many people as fast as they could have. When you get cash flow, you have to pay taxes generally. Now, every country is a little different, but in the United States, when you get paid, even if it's from cash flow from your investments, you got to pay taxes. And of course, not every asset pays cash flow. So things you want to think about. Which then brings us to the third question, which is, well, where do you invest? Is it stocks? Is it real estate? Where would you want to invest your money? Well, you got to decide what's right for you. I personally invest in both stocks and real estate, but you got to find what's right for you. The stock market's advantages are number one, it's accessible. Anybody can go out and start investing their money in the stock market from their phones. So it's pretty easy. It's lower cost to start. There's a lot of technologies out there that let people start investing in stocks with, less than $100. It can be passive, like we talked about with the set it and forget it system, and it's relatively simple to do that. There's brokerages that do that for you. You have high growth potential, like we've seen earlier in today's webinar, that there's a lot of ways to see high growth in your stock market portfolio. There are ways to minimize your risk depending on how you invest, like in a fund versus an individual company. 6, you get tax benefits, of course, in the United States. When you invest your money, you can get lower tax rates. And you get to own a piece of the economy. I mean, when you invest in stocks, you're investing in the companies that make up your country. Like in the United States, you can invest in the stock market, which means you're investing in the companies that make up our economy. The downfall with the stock market, though, is it's a paper asset. That means if you buy shares in, let's just say, Amazon, you get a piece of paper that says you own some Amazon. You can't go onto the Amazon website and say, give me some free stuff because I own a share of Amazon. That's not how it works. You also don't own the manufacturing plant. You just own a piece of paper that says, I own some Amazon. It can be more volatile because people can buy and sell stocks in, well, a second or a fraction of a second. So you can see stocks move up and down very quickly. You don't see home prices move that same way. Like if I buy a home tomorrow, the home price is not going to change by the afternoon. But if I buy a stock today, by the afternoon, it could be a completely different price. You don't really have any control over what happens to your companies in the stock market. If you go out and buy McDonald's, you don't get to tell the CEO what to do. The CEO decides what to do. If you invest in real estate, you do have more control. And of course, when you sell in the stock market, you got to pay taxes if you make a profit. So here's a list of stock market pros and cons that I just went over right here. Let's switch gears and talk about real estate. Real estate is tangible, meaning you can see it, feel it, and touch it, right? When you buy a property, you get the bricks, you get the windows, you get the land, you get the whatever flooring you have. So you're buying something you can see, feel, and touch. You can generate the cash flow. Generally, that's a big reason why people invest in real estate is because you can rent it out and make money every month. In the United States, you can get tax breaks on the cash flow. Again, although I am an attorney, I'm not your attorney. Just understand that there are tax break opportunities for the cash flow, which allow you to write things off. For example, in the United States, there's a deduction called depreciation, which says if I buy a rental property, every year I get to take a tax break because my property is 1 year older. That's available to real estate investors. And when it comes time for you to sell in the United States, you also get a different tax break. What that means is, let's just say I buy a property for, I don't know, $500,000. I own it for 3 years. It makes me money every month. And then 3 years later, it goes up in value to $1,000,000. So from 500,000 to $1,000,000, and then I sell. Well, now I have $500,000 of profit, right? Which means I have taxable income on $500,000. Well, in the United States, that's not true because in the United States, there's something called the 1031 exchange, which says you can take all $1,000,000 and use it to buy a bigger property and pay no taxes on that profit today. So there's a lot of tax break potentials with real estate, and you control it. So if I go out and buy a apartment complex tomorrow, I can change the color of the doors. I can upgrade the bathrooms. I can upgrade the kitchens. I can change the landscaping. I can change how we market the units. I can change what price we rent them out for. I can change the management company. I can change the contractors. If I go out and invest in Amazon or McDonald's, I don't get to do that. So again, get to decide what's right for you. The cons of real estate, of course, is it takes more money to start. If you want to go out and buy a property, you can't do that with $100. You have to be more involved, especially in the beginning. The first few years of me investing in real estate, it was stressful and very time consuming. I didn't know what I was doing. I had to meet the team. I had to know who the property manager was going to be, who's a good property manager. I had to find attorneys. I had to find real estate accountants. I had to work with the city hall. I had to work with a lot of people, contractors, to make my deals work. Now, today, fast forward more than a decade, I've built a team and it's significantly more passive. But it takes that work in the beginning, the physical effort of you doing it. It also takes more time. I mean, if you want to go out and buy a stock, you can do that in a fraction of a second. If I want to go out and buy a rental property, I got to go and start walking through properties. I got to write the offer with a real estate agent. I got to walk through the properties and make sure that it's good and talk to the city hall and get all that work done. And of course, you're the operator, which means, yes, it's a pro in the sense that you get to have more control, but it's also a con in that now it's up to you to make the decisions. You're the CEO of your real estate investing business. So here are the pros and cons of investing in real estate, which can help decide what's right for you. And of course, you don't have to pick one. Like I invest in both stocks and real estate. Real estate is a larger piece of a portfolio than stocks because I like it, but you got to decide what's right for you. So now we went over active versus passive investing. What's the better strategy for you? We went over cash flow versus growth, and we also went over stocks and real estate, which now brings us to the last part of this, which is how do you maximize your returns as an investor? And there's three things. I want you to write this down. There are three things that I want you to focus on. TRM. And what that stands for is time, return, and money. I'm going to go over what this means, but I'm going to take a quick sip of water. So if you've gotten value out of what we went over so far, let me get some guac, by the way. All right. Thank you, Nikki, Miriam, Carlos, Carmen. Thank you all for the guac. I appreciate that. So let's go over what does it mean with time. Why do these three things matter? So let's assume now that I can invest $1,000 a month. If I started investing when I was 25, which is the left chart right here, and I just got a 7% return, which is below the stock market average, that $1,000 a month over those 40 years would grow to $2.5 million. Now, let's compare that to, let's say, somebody who's 35 years old. And I also still invest the same $1,000 a month. They get the same below average 7% return. Well, now, just because I started 10 years later, I'm going to have less than half of the money, even though we're still investing for quite a bit of time, 30 years. It's less than half because time is one of the most powerful factors when it comes to building your wealth. But what you also need to remember is time is the only factor that you can't go back and change. So this is where what's important for you is if you really want to succeed, it's better to start sooner rather than later. So how do you have more time? Well, you got to start now. Remember, this is the only factor that you can't control. The second thing is the R, the return. And this is where now it's how can you work to get better returns? So let's go through these examples. Let's assume that you can invest the $1,000 a month. You invest for 40 years. That's both examples. And on the example on the left, you're getting a 7% return on your money, which means your money, you would grow to $2.5 million. But on the right, it's the same thing where it's $1,000 a month you're investing for 40 years, but now you're getting a 10% return, which has been the historical average. Now you're going to have over double what you would have had before, more than $5.8 million, just because you were able to get a little bit higher returns on your money over the long term. So this is where the return is so important. Now, the question is, how do you get better returns? Well, you can work on building your financial education, right? That's what the Smart Money Quest is about. Is how do you build your financial education so you can understand different ways to make a little bit better investments. It doesn't have to be drastically better. See, a lot of people assume they have to make these amazing investments to make a lot of money. Well, it's really not true. If you just make slightly better investments, you can see huge returns over the course of your career. You can also work to lower some of the fees that you pay or understand the difference between active versus passive investing to see what can get you a little bit better returns to get you better wealth. Or the third is, of course, money. We'll compare now investing $1,000 a month versus $500 a month, both invested for 40 years at the 7% annual return. If you invest $1,000 a month, that will take you to $2.5 million. At $500 a month, that'll take you to about 1.2 million. So, of course, the more money you invest, the higher potential wealth that you can build. And how can you have more money? Well, you can either work to spend less or earn more. That way you have more money to invest. Not working to earn more money so you can drive a nicer car. It's working to have more money so you have more money to invest and then let your investments buy a nice car, right? I want you to have the nice things. I want to make sure this is clear. I want you to have the nice cars. I want you to have the nice clothes. I want you to have the nice vacations and the freedom and all of that. But I want you to be able to afford it. And the best way to afford it isn't to make money so you have more money to spend. It's to make money so you can buy investments and then you let your investments pay for all that other stuff. That's real freedom, but it's difficult because that means you're working to make money that you don't spend. You're working to make money so you invest it. And then you have to let your investments make more money that we have more money to spend. And that's where, the reality is most people don't want to go through that, but that's what every wealthy person works for. If you can do that, then you build true freedom because now your investments will keep paying you even when you're not working. So I'm going to put it all together now. If you've gotten value out of this, we're already getting some guac coming in. Thank you, everybody, for the guac. The financial education now is more important than ever. And the reason why is, well, like we talked about, this has been happening, but in the last 5 years, it's really accelerated. Where in the last 5 years, we've seen household incomes only grow by around 20%, while at the same time, the reported inflation numbers are just over 22%, even though the real inflation many people feel is actually a lot higher than that. Over the same 5 years, home prices have grown by 50 some percent, and the stock market has grown by over 80%. So the investors have built so much more wealth over the last 5 years versus the people that are not investing have not. They're getting left behind, which is why this is so important. Now you got to understand, we will see another recession in the future. We will see another market crash in the future. But those create investment opportunities. Market crashes and recessions create more millionaires than any other time because they create opportunities for people to go out and buy more. And most people panic, get scared, and sell out of everything when those bad things happen. Versus the financially educated, use them as an opportunity to buy even more. Because if you can withstand those and buy more, you can build even more wealth. Which assets have built more wealth than anything else over the last century? Businesses, real estate, and stocks. And today we focused on real estate and stocks. And in order to decide now how, in the financial education side, how do you want to invest your money? We talked about active versus passive investing. We talked about investing for cash flow versus growth. We talked about investing in stocks versus real estate. And then we talked about how you can maximize your returns with time, the return that you get on investments, and how much money you invest. And from there, we're going to go into the next section, which is the question and answer. And of course, for all of you that would like more, you can check out the Smart Money Quest at Mindvalley because I go even deeper into all these topics in that. But I'm going to now stop sharing so we can do our question and answer section. And I'm going to bring back the Mindvalley team so we can go even deeper. Thank you, everybody, for your support, by the way.
Thank you so much, Jaspreet. Wow, that was a lot. That was so much in so little time. Thank you so much for that. Actually, before we get on to the question and answer, if that's okay with you, Jaspreet, I would like to share with the audience about your quest that you have on Mindvalley.
Sure.
All right, thank you guys. So just let me know. I'm going to share screen for now. Let me know if you guys can see the screen. Can you see the screen? Just let me know with a yes in the comments. All right, I'm getting yes. Great. Okay, guys. So if you want to embark on the full journey to financial success with Jaspreet, I really highly encourage all of you to sign up for his quest, which is especially designed for Mindvalley. It is free for your Mindvalley membership and for all Mindvalley members. You just have to type in Smart Money in the search bar and start the program. It's available on all devices, so you can do this sitting down at home, or you can also listen to it on the go. But there's a lot to write down. I was writing down a lot, so I think for this quest, it would be better to have a notebook and just write everything down. So the amazing thing about this quest is that it isn't just education. Like in today's webinar, as you notice, Jaspreet really gives practical tools, So he's going to give us in this quest a practical roadmap to financial empowerment. There are tools in the quest, there are exercises to master the strategies so you can build a strong foundation for your future wealth. So let's just have a look at the curriculum together. Part one is designed to redefine your relationship with money. You will shift your mindset and acquire the core competencies of money management. So you can see here the quadruped theory. The quadruped theory is the tool you will use to redefine your relationship with money. You'll learn about good versus bad debt, and you will learn when incurring debt makes sense and how to do that in the most beneficial way. You will also learn about saving. Why and how should we save? I see you guys writing so excited to start the quest. Me too, actually. So why and how should we save? Why might saving not be such a good idea? And much, much more. In part two, we're going to go into more advanced tools of investment strategies and wealth building techniques. You're going to learn about passive and active investing and really dive into the world of stocks and bonds. By the end of part two, we will all be smart players in the investment game. In part two, you're also going to learn about real estate and how you can make this a part of your wealth building strategy and how you can create different streams of passive income. So essentially, all of you, just to sum it up, you'll be given all the tools to design a sophisticated path to financial freedom. So not only the best financial tools, but also the mindset tools you need to carry on this path with confidence. So before we start the question and answer, I just want to leave this here for 30 seconds. Just scan the QR code and you can either sign in to your Mindvalley account or you can subscribe to become a member so you can gain access to this quest. So I'll just leave that here for a little bit and check out the comments. So Roger is saying, thank you for the quest. I also agree. Thank you for, like I told you guys, the quest is tailor-made for Mindvalley, just for you guys. So with all of his best, most practical knowledge that you guys will need to create this roadmap. Tari is saying, I'm starting the quest today. Thank you for having this live. I'm starting it tomorrow, so I'm pretty excited as well. Maida, the quest will be in Spanish. Surely it'll be in Spanish. I'm guessing sometime in the future. For now, it's not available in Spanish, but we will be announcing when there are translations up. Duffy signed up for the quest at the beginning of the webinar. That's great. Amazing, guys. I'm really excited for all of us. You can also, if you guys want to check them out in the stories platform, you can also read a lot. We have so many stories from people, and there's so much value from it. So what I really love about it is it's only 20 minutes a day. So 20 minutes a day for 2 weeks. And with that little time, you will have already planned out your financial freedom path, and that's going to serve you for the rest of your life. So it's just 20 minutes for 14 days for a path to embark on the rest of your life. So I agree with the people in the chat. Thank you so much, Jaspreet, for creating this quest, and I'm really excited to start it tomorrow. How do you want to go about the question and answer round? Would you rather me have a look and tell you verbally, or would you rather read out the question yourself and you sort of decide which
Yeah,
one?
how about you read them to me? I would
Sure,
just
I
like
would
to
like
add.
that.
Oh,
That
sorry.
sounds good. Okay, so I'm gonna
Yeah,
go
and I
with
would just like to
the
add.
just gonna go with the most upvotes.
Oh, sorry. I don't know if
So
my internet.
maybe it's me. Let's just have a stop for now. Okay.
All right, I think it's back to normal. Sorry, I would just like to add, yeah, the Smart Money Quest, we created especially for Mindvalley members. We have our own education, but what we have at Money, this was built specifically from Mindvalley, so you're not going to find this anywhere else. And it's a lot of fun, and I think it really adds a lot of value. So if you're starting your financial education journey, or even if you are investing your money right now, I think you'll get a lot of value out of it. And we make it fun and engaging. There are action steps to take to how you can have more money and how you can start investing your money so you can build your wealth. So I think, if you're thinking about it, I think you'll really get a lot of value out of that over there.
Yeah, thank you so much. And one of the things we get so much on the stories and on the people having done it is not only all the tools and everything that you give them to build this amazing financial journey to financial freedom, but also the way you explain it's just really practical, really clear. People can go ahead right away and use the tools that you teach.
Yeah, it's funny. I get a lot of heat from financial advisors because I'm not a financial advisor. But I would just like to say everything that I teach is just from my own experience. So I don't teach from a textbook. I teach from the mistakes I made because I have made a lot of mistakes. So, everything that I teach is really just like I screwed up here, which is why I talk about this. So, it's a little different than what you'll see from other financial education stuff for that reason, but it's everything from my own experiences. I don't teach anything that I haven't done or generally I haven't screwed up at, because until I screw up, I don't actually know something.
Hmm. Hmm. You sort of paved the way, just letting us know like it's better not to do that because I've already been there. That's really great.
Yeah, I would just rather you, I mean, I want to be real. You're gonna make mistakes. You're gonna
Mm-hmm.
screw up. I mean, there's no way to bypass the experience. You have to learn from experience. That is a there's no way to bypass that. My goal is just to lower the learning curve a little bit. That way you can hopefully make less mistakes as me and less expensive mistakes as me, because I made a lot. I'm talking about some of them on YouTube. If you want an example,
Yeah.
to see some of my mistakes, I have a video on my YouTube channel. I think it's called My Worst Real Estate Deal Ever, My Nightmare Property, and you will see how bad of mistakes I made and how costly they can be. So I mean, I'm I've learned a lot in the 13 years that I've been doing this, which is what has allowed me to be better. But everything that I talk about is just from the years of experience. It's not 6 months of me trying something and then talking about it. It's just more than a decade of me doing, trying, refining, making more mistakes, refining and trying.
Mhm. Yeah, I see in the chat, Roviel says you're so generous. Thank you for sharing your life experience knowledge. And I agree. I mean, you could have just made the mistakes and kept the rewards for yourself, and you chose to create these platforms, these avenues where you share all this knowledge. So thank you so much for that and for today as well.
Yeah, well, thank you. I appreciate it. It was a lot of fun. And it's just unfortunately, most of us are never taught financial education. Most of us don't grow up with parents telling us what to do with money. We don't grow up with teachers telling us what is investing. We learn to go to school, get a job, and just do kind of the traditional stuff, which is fine for some people.
Mhm.
It just wasn't the right path for me. And I think
Mhm.
a lot of people, they want more in the sense that I want to have the ability to have more financial freedom, maybe not have to wait until I'm 70 years old to have wealth. And how do I have more wealth? How do I build more financial freedom? How can I give back to my parents? How
Yeah.
can I have more money to take care of my spouse? Like, I mean, it's crazy. It really bugs me to an extent. And I don't want to get into like my personal opinions and emotions on this, but like, I really, from a young age, wanted to be successful. And the reason was because I wanted to give back to my parents. Um, And so I thought, okay, how do I become successful? I go to school and study hard and get good grades, because if I get good grades, I can make more money. But
Mhm.
that's not exactly how it works. And so this is where, my financial education is kind of like, okay, well, there's the traditional education, which is fine, but there's also the financial education, which is the where the wealth is. So, the Mindvalley quest goes deeper into that. And then for anybody who likes the deep breakdowns of what's happening in the markets, that's where my newsletter, Market Briefs, breaks it all down. And you can just do a Google search to find that too.
Yeah. Thank you so much. And I think all of us here is the all of us that are here, and that's exactly what we want. We want that how, because I know all of us are here because we want that change. We want to change our future. We want to become financially free, not wait until we're older in a certain stage in our life that society's been telling us. And so I love that this is a sort of fast forward and uh, here is all the tools that you need without the quote unquote bullshit ideas. That's it may work for some people, the traditional method, but I think a lot of people are finding out, as you did, that that's not mostly it's not the case.
Right.
Mhm. So if you don't mind, I'm gonna go with the most upvotes, the questions with most upvotes in that
Let's do it.
order. It's
Let's do
okay.
it.
All right. So Miriam is asking, what's your view on Bitcoin and the blockchain?
Well, I have bought Bitcoin. I've been buying Bitcoin since 2017. I was buying Bitcoin when it was around $3,000 a coin. It's a speculative asset in my portfolio. I again, if you look at the last 100 years, real estate stocks and businesses have built more wealth. So that's where my investments are. I own I in my speculative part of my portfolio, which is about 16 to 18% of my portfolio, I
Mhm.
own and invest in startups and some cryptocurrencies. I've also sold off a big chunk of Bitcoin because, I've made a huge return on it, and I, using that money to buy more cash flowing assets because, when I see my Bitcoin go from 3,000 to $70,000 a coin, well, I don't actually make any money until I sell. So I transferred some of that into cash flowing assets. I do think it's speculative. I believe in it. But I also understand the speculative can go back down to zero, which is why it's a part of the speculative piece of my portfolio where I believe it can go up quickly, but it can also go down to zero just as fast. I made a video on my YouTube channel actually a couple weeks ago on this about why I sold some of my Bitcoin.
Mm-hmm. Thank you so much. So speaking, as we were speaking of age and everything, Diane Ayon is asking, I'm 68 years old and currently working. I'm just beginning my investment education. Do you have any suggestions for investing at my age?
Yeah, the education is the same, regardless of where you are. If you remember the end of this workshop, there's three factors that'll determine your wealth. It's TRM, time, return, and money.
Mhm.
So the only factor we can't control is time. Obviously, it's a very powerful factor. But if you don't have, the same level of time as somebody who's 25, you got to make up with that with higher returns and higher money. And this is where now, if you want to get in your financial education journey, that's great. It's never too late, but you're going to have to now make up for the lost time through more financial education and earning more money so you have more money to invest.
Mhm. Mhm. Yeah, thank you. So somebody handed in a question anonymously, and they're asking, do you invest in real estate in countries you're not a citizen of? If yes, which ones and why?
I don't. I only invest in the United States.
Mhm. Jose is asking, could you explain why buying gold is a strategy? I hear that is a hedge against inflation, but how does it work? Is it to buy
Sure.
and later sell to regain the cash? And same question about silver.
So again, I can only speak to what I do.
Mhm.
Um, 2% of my portfolio is physical gold. It's not a contract, it's physical gold. Why? For me, I look at gold as a hedge against inflation. I look at it as a form of hard money. So what I mean by that is if I take $10,000 worth of gold today and $10,000 of paper cash and I bury it in my backyard today, my theory is that the gold will have more buying power in 10 years than the cash.
Mhm.
So it's a form of, for me, hard savings. I don't look at gold as an investment.
Mhm.
I don't really care what's happening with the price of gold. I just buy a little bit more gold every month. Um, and that's just what I do. And that is a form of hard savings and insurance against doomsday. It's a gold has been currency since before we have been here. And so, for me, that's all it really is. I don't really watch the price of gold like that. I just buy a little bit every month.
Mhm. I understand. Thank you. Audrey is asking, how do you invest in funds? Are those mutual funds? Do you invest from a TFSA account?
So the way you invest in funds is going to depend on you. I can't give you financial advice, but like I said in the workshop, you have ETFs, mutual funds, and index funds. An ETF trades like a stock, so you can buy an ETF pretty much at any stock brokerage out there.
Mhm.
Mutual funds and index funds, some brokerages, like regular brokerages, will let you buy them right on the brokerage. Other times you're going to have to go into the actual institution that created these funds. So, for example, one of the large fund managers out there is Vanguard. They're a very popular one.
Mhm.
If you wanted to buy an index fund or mutual fund by a Vanguard, some brokerages will offer them. Or you can just directly go to the Vanguard website and buy them right from the website.
Mhm. I understand. Thank you. And the same person is asking if you recommend crypto, and if so, which one?
Well, I can't tell you what to purchase.
Mhm.
Uh,
Yeah.
and if it's right for you, it's right for you. I don't want anybody to buy something they don't understand. So if you don't understand what it is, don't buy it.
Yeah, and that's a great answer. And I'm sure, I mean, you'll get more insight from doing the quest and more understanding about which one is right for you. Um, so this is an interesting question. It's from Adin Wissinger, and sorry if I'm mispronouncing some of your names. Asking, how can I make my investing something purposeful? It's important for me to invest in things that have a purpose to regenerate sustainability and with good working conditions. How do I make sure I'm doing
Yeah,
that?
that's an absolutely great question. I mean, it's just being purposeful with where you invest. So if it's in real estate, maybe that means you're investing in neighborhoods which you're going to come in and revitalize.
Mhm.
Most of my real estate properties that I've invested in are uh, deals that they were properties that needed work. So, for example, there was an area, a neighborhood that I invested in where I purchased an apartment complex that was turned into a drug house. It was just a bad, it was a good neighborhood, bad property. A lot of bad things were happening there. There was police there all the time. We bought it and we turned it around. We had to kick out the people that were causing trouble. We rehabilitated the entire property, renovated it, and turned it from a crime hub to a desirable place to be. And
Mhm.
what does that look like for you? Well, it's just how do you get involved? Same thing with stocks. I mean, you can invest in companies that you believe are um, good investments.
Yeah. Yeah, yeah. And like you said, do your research and really be more careful and mindful about that. So Miriam is asking about stocks. She's wondering if there's a way and how do we know when to sell our stocks?
So selling is there's a lot of ways to think about selling. Number one is if you have a goal, if a company goes up to what your goal is, that could be a reason to sell.
Mhm.
Secondly, if you believe that the company is now overvalued, that could be a reason to sell. Thirdly, if you need the money, that could be a reason to sell.
Mhm.
Fourthly, if you find a better investment opportunity, that could be a reason to sell.
Mhm.
Generally, I don't like selling. I want to own. That's my goal is just to own and keep stacking because I like cash flow, so I can just keep buying more and more and more and keep letting the cash flow stack. But it's going to go back to what your strategy is. And I know we didn't get into the selling strategy here,
Mhm.
but there's a lot of strategy that's involved in when do you buy, when do you sell, but it's going to depend on what are you buying, why are you buying, what is your goal, and how do you realize that goal.
Yeah, yeah. Thank you. So Hajra wants to know a little bit more about debt. So she is in debt and she's wondering, how do I get out of it? Should I start investing and use that money to pay my debts, or first pay my debts and then start investing?
Well, again, I can't tell you what to do, but I would rather pay down the debt first. It's more direct.
Mm.
And it also depends on what kind of debt it is. If we're talking credit card debt, high interest debts, pay that off because it's a higher return than what the markets will give you.
Mhm.
So, um, there's a lot of content out there on YouTube of like debt pay down, but at the end of the day, to pay down your debt faster,
Mhm.
you need more money to pay down the debt. And you want to get aggressive with that. So you can spend less or earn more to have more money to pay down the debt.
Mhm.
But I personally, I mean, unless we're talking about lower interest rate debts, I would rather pay down the debt first.
Mhm. Yeah, thank you. Miriam wants to know how much percent, if any, if there's a defined percent or one that you would recommend, of your income would you invest per month and how much to keep as a safety in our banks?
So I generally like to talk about a 75-15-10 plan, which
Mhm.
says for every dollar that you earn, 75 cents is the maximum you can spend, 15
Mhm.
cents is the minimum you invest, 10 cents is the minimum that you save, just as a
Mhm.
rule of thumb. And then you can adjust. Generally, I like to invest more. And as you hit your savings goal, then you can turn that savings money into your investment money.
Mhm. Thank you. And we have a couple questions about real estate. So most of them have to do with if you believe that real estate will fall or continue to skyrocket with a recession. Essentially, they're asking, should we keep investing in real estate? Should we put more into real estate?
Well, real estate is localized. So, a neighborhood can fall and another neighborhood can rise. In the United States right now, I'm in Michigan.
Mhm.
The Midwestern part of the United States, property values are rising. Big cities like Austin, Texas, real estate prices are falling.
Mhm.
So, it's hard to give a clear-cut answer because it just depends.
Yeah.
Um, I Real estate prices go up and down. I mean, it's a fact. For me, I just want to have margin. What that means is I look for a 7% cash on cash return. That means that every month the property will generate income from the rent, pay off the expenses, and generate a 7% return. What that means now is if a recession happens tomorrow, I can lower the rents and still be profitable.
Mhm.
And so my goal is cash flow. I don't really care what property values are doing. I want the cash flow. and I want to make sure I have margin. That way, if a recession happens, I can lower the rents and still be profitable.
Mhm. I understand. Thank you. We have two questions on AI. So one person is asking, what is your view about setting up AI payment system for taking payments from your clients? And is AI payment available in all currencies? How do you feel about AI
Well, I
when
mean,
it?
artificial intelligence is just it's a technology. I mean, it's very powerful. We use it in our own company.
Mhm.
So, I think it's very useful if you know how to use it. I'm not really sure what you mean by AI payments, but it's just like technology, right? When the internet came out, some people were very skeptical. They hated it,
Mhm.
but some people knew how to use it. So, you can look at it from an investment perspective. Everything goes through booms and busts, but I like AI. I don't know who wouldn't. I mean, yeah, obviously it could take jobs and have those reasons, but learn how to use it.
Mhm. Thank you. Jaron Smith is asking, there's constant rhetoric that we're in the tipping point of a Great Depression. What are your thoughts about keeping our investments in the markets? Should one be hedging by taking out some investments to house in a high yield savings account?
Well, if you bought at the peak before the 2008 recession, you would still be profitable today. Of course, 2008 to 2012 were very rough.
Mhm.
Nobody can time the market. I think there's a lot of red flags in the economy, but you can't time the market. So I'd be prepared for both. I buy stocks every Wednesday.
Mhm.
I also put money into a bank account. That way, if an opportunity comes, I can purchase.
Mhm.
The market crashes create some of the best opportunities ever.
Mhm.
When markets go down, it creates huge opportunities, people that are prepared.
Mhm.
When you're not prepared, you can't take advantage of them. So, I mean, you can't time the market, but you can win in both markets.
Mhm. Mhm. Thank you. So John is asking, do you recommend working with a fiduciary financial consultant?
They're right for the right person. I mean, I'm not against financial advisors.
Mhm.
What say is you have to have the base level of financial education going in. That
Mhm.
way, you can guide your financial advisor and see if they're giving you something that aligns with your goals.
Yeah.
It's like going in. It's like if you were given a bad medical diagnosis, you want to get a second opinion or a third opinion or fourth opinion from a doctor.
Mhm.
You want to make sure your financial advisor is doing something that aligns with your goals, that's going to build wealth the way that you want. And that requires you to have some financial education too.
Mhm. Definitely. Thank you so much. Rajal is asking, how important is diversification within an asset class and across different asset classes?
Well, again, it depends.
Mhm.
Warren Buffett says that diversification is for people that have no idea what they're doing.
Mhm.
Other people, you might not know what you're doing. And so diversification is great, right? I mean, when you buy a fund, you're diversifying. When you buy
Mhm.
the S&P 500, you're diversifying.
Mhm.
You diversify if you don't know what the next Amazon is. So, there's a reason to diversify. There's other reasons not to diversify, right? When
Mhm.
I go big onto my business and I invest into that, I'm focusing on one thing, hoping that it'll make bigger returns, higher risk, higher potential returns.
Mhm. Yeah, thank you. So Luke is asking to invest in SP 500 now or wait for a crash in the next 6 months. I have a lot of capital and I can't afford to be down 30 to 40% at any given time. Could you please share with me your thoughts? Thank you.
Well, if you can't afford to be down, you shouldn't invest. Um,
Mhm.
you don't want to invest more than you're willing to lose. That's the first point. And secondly, you just got to find the right system for you. I mean, you don't have to dump all of your money in today. No one knows what's going to happen tomorrow.
Mhm.
And so, I mean, if you can't afford to lose, don't invest your money.
Mhm.
And so, build the right system, the strategy that works for you.
Mhm. Great. I think we have time for one more question. So Miriam is asking, what do you think about the incoming bank crash, stock market, and the fiat dollar crash?
Well, things are always going to crash. I mean, I think it's a part of the system. I mean, people have been talking about a dollar crash
Mhm.
since the 70s, maybe before. Um, Obviously, there's risks. Obviously, the risks are greater today than they were in the 70s, but there's
Mhm.
also opportunities. And so most people fear, my goal is to find the opportunity. So, if I want to be able to win when markets are up and when they're down. And I think a lot of people just get scared and they end up sitting on the sidelines and then they lose out on huge opportunities. You got to figure out how you can win in
Mhm,
both sides.
mhm. Thank you so much, Jaspreet.
Thank you for having me. It was a lot of fun.
So much. Thank you for answering the questions so just directly, so honestly, and like we're saying, so based on your experience. I want to ask you, what is the best way that everybody here can find you? I know that you have a very, very popular YouTube channel, Minority Mindset. I know they can find you there. They can go to Briefs Media and get the newsletter. Where else could people find you?
Those are the best places. Check me out on YouTube, Minority Mindset, or go to Google and search Market Briefs, which is our free newsletter that we publish through Briefs Media.
Mhm.
And love to hear from you.
Mhm. Thank you so, so much.
Thank you.
Thank you. And for everybody here, I'm just going to post the QR code again so you guys can access the quest. There you go. Thank you. I see everybody is giving thank yous. Thank you guys for being
Thank you
here,
all.
guys, for
See you
investing
later.
in yourself today. Thank you so much, Jaspreet.
Bye all.
Bye. Have a wonderful day.
Take care. Thank you again for the opportunity.
Bye. Thank you so much, guys, for being here. Wow, that was so much. If you already have it, if you already know how to get to the quest, how to start the quest, then please feel free to leave. And if not, just stay one more minute and I will share this with you guys. So I'm just going to leave this here. And in the meantime, having a look at the chat, if anybody has any questions for me. I'm sure there'll be a replay. We will be emailing you about it. So all the participants, if you signed up for this, then we'll be emailing you about where you can find the recording, where you can find the quest. I'm from Argentina. Thank you for asking. The quest name is Smart Money, Smart Money by Jaspreet Singh. So you can either go to the search bar and search his name, or you can search by quest name, Smart Money. Thank you, Miriam. Thank you so much. Diana Calabro, yes, thank you so much. Thank you. And I really, really encourage you all again to start this quest. Like I said, it's 20 minutes, which is what most of our quests here at Mindvalley are in time, but it's 20 minutes just for 14 days. And he's really gonna give us really a way to just set out our strategy for the rest of our lives. And that's the main reason why I want to do it, because it's so little time investment that gives back years and years in the rest of our lives. So I'm really excited about it. I'm a bit nervous to start it, but really excited. Janvir, I've started already and it's so informative. Yeah, he's an amazing teacher. I mean, it's just the way he teaches is so clear, so practical. Carly, thank you so much. I'm going to do the quest as well. That's great, guys. Great. Okay, really excited for that. And thank you so much again, everyone, for being here. Have a wonderful morning if it's morning for you, afternoon, or night if it's night for you. Thank you so much, guys. Saludos and goodbye. Thank you. Bye.